Everyone is watching gold, the headlines, the record highs, the breathless commentary. But while the world stares at one metal, something else moved this morning, and quietly, almost unnoticed. Silver did something that gold did not do, and the reason behind it has nothing to do with panic or hype or speculation. It has to do with a number released at 8:30 this morning, a number most investors will scroll past without understanding. But that number is the reason silver is now sitting in a position it has not occupied in years. By the end of this video, the connection between that number and silver's next move will be impossible to unsee. And once it is understood, it will change how every serious investor looks at the next 90 days. Welcome to Currency Arc Insight, the channel built for those who read markets, not headlines. If this is your first time here, consider subscribing, because what follows is the kind of analysis decision makers act on before the rest of the market catches up. Drop a comment below and let us know which city, which country, which desk you're watching from tonight. At exactly 8:30 in the morning, two reports landed from the same government office at the same moment. Analysts across the world had been waiting for these numbers for weeks, and within seconds of their release, trading desks from New York to Singapore began reacting in real time. The first number measured the growth of the American economy. It came in at just 1.5% for the second quarter of the year. Economists had expected something closer to 2.3%, so this was not a small miss. It was a significant gap between what professional forecasters believed would happen and what actually happened. A quarter earlier, the economy had grown at 2.1%, which means growth had slowed by a meaningful margin in just 3 months. The second number measured inflation, using the exact gauge that the Federal Reserve watches most closely. That number came in at 3.3% for the year, still well above the 2% target the central bank has spent years trying to reach. This was not a one-time reading either. Inflation had now held at this same elevated level for 3 consecutive months, refusing to move down in any meaningful way. On their own, each of these numbers might look manageable. Positive growth is still growth. Inflation running hot is not unusual after major economic shocks. But when these two numbers are placed side by side, something else becomes visible. An economy that is slowing down while prices refuse to come down at the same time. This combination has appeared before in economic history, and when it appears, it tends to change everything for the assets people rely on to protect their wealth. Gold understood this within minutes. The price broke above a level it had failed to clear for 2 full weeks, pushing past $4,100 per ounce with clear conviction. For 15 straight trading sessions, gold had been trapped in a narrow range, unable to move higher. The moment this data hit the wires, that range broke apart. Traders who had been waiting on the sidelines moved in at once, and the metal that so many consider a symbol of safety did exactly what history says it should do when uncertainty rises. Silver told a very different story. While gold surged, silver barely moved. It opened the day lower, recovered slightly, but stayed well below a key psychological level that traders have been watching for months. For a metal that is often described as gold's more volatile sibling, this kind of stillness on a day of major economic news was unusual enough to raise real questions. Why would one metal react so strongly to the same information while the other stayed almost silent? Both are priced in the same currency. Both are traded on the same exchanges. Both are influenced by the same central bank decisions. Yet, on this particular morning, they moved in completely different directions in terms of intensity, and that difference is not random. It comes down to something structural in how these two metals are actually used in the real economy, something most casual investors have never been taught to think about. Business leaders and serious investors do not have the luxury of only watching headlines. They need to understand what is actually happening underneath the numbers, because the difference between gold's reaction and silver's silence is about to matter a great deal in the weeks ahead. The Federal Reserve now faces a decision at its next major meeting, and that decision will be shaped directly by the very data that came out this morning. Whichever direction the central bank leans, it will not be a simple choice, because the same numbers that argue for one policy also argue against it. This is where the real story begins. Not with a single data release, but with the tension it has created inside the world's most powerful financial institution. A tension that has already shown up clearly in the price of gold, and that is quietly building underneath the surface of silver as well, even though the market has not fully priced it in yet. What comes next explains exactly why an economy that is slowing down while inflation stays high has historically been the single most powerful setup for precious metals in modern financial history, and why the coming weeks may determine how far that setup is allowed to run. To understand why serious investors are paying close attention to this moment, it helps to understand a concept that rarely gets explained properly, even though it shapes entire decades of financial history. The concept is the condition where an economy slows down and prices refuse to fall at the same time. In a normal economic cycle, these two forces are not supposed to happen together. When an economy slows, demand usually falls with it, Businesses sell less, so they stop raising prices, and sometimes they lower them to attract customers. When that happens, inflation naturally cools down alongside growth. It is a self-correcting system, and for decades, central banks have relied on this relationship to manage the economy. Raise interest rates when things grow too fast, cut them when things slow down, and the system tends to balance itself out. But every so often, that relationship breaks. Growth slows down, yet prices keep climbing anyway. When this happens, the central bank finds itself in a position with no good options. If it raises interest rates to fight inflation, it makes borrowing more expensive at the exact moment businesses are already struggling and consumers are already spending less. That risks turning a slowdown into something much worse. If it lowers interest rates instead to support growth, it risks pouring more fuel onto inflation that is already refusing to come down. Whichever direction it chooses, there is a cost, and there is no clean path that solves both problems at once. This is exactly the position policymakers find themselves in right now. Growth has slowed well below what was expected, while inflation remains stuck above target for a third straight month. 3 officials within the central bank's own decision-making committee have already voted for one direction, while others clearly favor caution. This kind of open disagreement inside the world's most powerful financial institution has not been seen in nearly a decade. When the people responsible for managing the economy cannot agree among themselves, it tells everyone watching that there is no obvious right answer left on the table. History offers a useful reference point here. In the 1970s, the world experienced a stretch of years where growth stayed weak while prices climbed relentlessly. Oil shocks played a role, and so did years of loose monetary decisions that had built up before anyone recognized the danger. During that period, paper assets struggled badly. Stock markets moved sideways for years once inflation was factored in. Bonds lost real value because their fixed payments could not keep pace with rising prices. Cash sitting in a bank account quietly lost purchasing power year after year, even while the number on the statement stayed the same. One asset behaved differently. Gold, freed from the fixed pricing system that had controlled it for decades prior, rose from around $35 an ounce to well over $800 an ounce within roughly 9 years. That is not a small move. It is one of the most dramatic wealth transfers in modern financial history. And it happened specifically because paper promises were failing to protect value while a physical, tangible asset was not. No serious analyst is suggesting history will repeat itself in exact detail. The tools available to central banks today are different. Markets are more interconnected. Information moves faster, and policymakers have decades of additional data to draw from that did not exist in the 1970s. But the underlying mechanism, the specific trap of slow growth colliding with stubborn inflation, is not a relic of the past. It is a recognizable pattern, and right now, the early signs of that same pattern are visible again. This is precisely why gold's reaction this morning cannot be dismissed as a short-term trading move. When the market senses that a central bank may be cornered with no clean solution, capital does not wait for confirmation. It moves toward the asset that has, across many decades and multiple different economic crises, consistently held its value when paper promises could not. But gold is only half of this story. The other half, the part almost nobody is currently paying attention to, involves a metal that behaves very differently from gold, for reasons that have nothing to do with safety and everything to do with how the modern economy actually functions. That difference is exactly where the next part of this analysis begins. Every serious business mind eventually learns that not all valuable metals behave the same way, even when they sit side by side in the same market reports. Gold and silver are often mentioned together, almost as if they are 2 versions of the same asset. But the truth is far more layered, and understanding that difference is exactly what separates casual observers from people who actually study markets for a living. Gold in the modern financial world carries almost no industrial burden. It is mined, refined, and largely stored, held, or worn. Its primary function is to serve as a form of protection, a place where capital goes when trust in paper currency weakens. Because of this, gold responds almost entirely to questions of safety, trust, and monetary policy. When investors sense trouble brewing in the financial system, gold reacts quickly, because nothing about its demand depends on how factories or power grids are performing. Silver carries a very different weight on its shoulders. A large majority of the silver produced every year, well over half, does not end up in vaults or jewelry boxes at all. It goes directly into industrial use. It becomes a critical component in solar panel manufacturing, where its conductive properties make it essential to converting sunlight into usable electricity. It goes into electric vehicles, semiconductors, and a long list of electronic components that quietly depend on this metal to function. In other words, silver is not just a store of value, it is a working metal, tied directly to the pace of real economic activity around the world. This is precisely why silver stayed quiet on a morning when gold surged. The same report that excited gold investors carried a very different message for silver. A weaker than expected pace of economic growth raises a natural concern about industrial demand. If businesses are producing less, building less, and investing less, then the logic follows that they may also need less of the raw materials that feed those activities, and silver sits directly in that category. So while gold investors saw a signal of safety, some silver investors saw a signal of caution, and that hesitation is exactly what kept the metal from moving alongside its counterpart. But hesitation based on a single data point is very different from a genuine change in the long-term picture, and this is the distinction that experienced investors pay close attention to. A slower quarter of economic growth does not undo years of accumulated industrial demand for silver, and it certainly does not solve a supply problem that has been building for a long stretch of time. The short-term reaction and the long-term structural reality are simply not the same story, even though they are unfolding at the same moment. For 6 consecutive years now, global demand for silver has outpaced global supply. Mines are not producing enough silver each year to meet what industries, investors, and manufacturers actually need. That gap has to be filled somehow, and the only way to fill it has been by pulling from existing stockpiles that were built up over previous decades. Those stockpiles are not unlimited, and every year that passes without a correction in the imbalance makes those reserves thinner. This is the part of the story that rarely gets attention in the middle of a single morning's headlines. A shortage that has been quietly building for 6 straight years does not disappear because one economic report came in soft. If anything, a slower economy paired with a persistent structural shortage creates a very different kind of tension underneath the surface, one that has little to do with today's price movement and everything to do with what happens when existing stockpiles eventually run too low to keep covering the gap. This is why silver's silence this morning should not be mistaken for weakness. It is closer to a pause, a brief moment where short-term industrial concern is overshadowing a much larger and much older imbalance that has not gone away. Markets often misprice assets in the short run based on the emotion of a single data release, while the underlying structural story continues moving in the background, regardless of daily headlines. Understanding this distinction is exactly what allows serious investors to see opportunity where others only see hesitation. And once the relationship between silver and gold is examined closely, the picture becomes even more compelling, because history has shown what tends to happen when these two metals drift far apart in value, and what tends to happen next once that gap becomes too wide to ignore. There's one number that experienced investors watch closely whenever gold and silver begin moving at different speeds, and it is a number that rarely makes headlines, even though it carries enormous weight. It is called the gold to silver ratio, and it simply measures how many ounces of silver it takes to buy a single ounce of gold at any given moment. Right now, that ratio sits close to 70, meaning it takes roughly 70 ounces of silver to match the value of 1 ounce of gold. Over the past 50 years, the average level for this ratio has been closer to 65. When the ratio climbs well above its historical average, it tells a very specific story. It means silver has become unusually cheap when compared to gold, even though both metals are shaped by many of the same economic forces. History does not treat this kind of gap as permanent. Time and again, when the ratio has stretched to elevated levels like this, it has eventually started to move back toward its long-term average. What makes this moment particularly interesting for serious investors is what tends to happen during that correction. Both metals often rise during these periods, but silver has historically moved faster and further once the shift begins, precisely because it had fallen so far behind gold in the first place. In simple terms, silver is not just cheap on its own, it is cheap relative to the metal it is most closely compared to, and that kind of gap has a long history of eventually closing. This becomes even more significant when placed next to the supply problem discussed earlier. For 6 straight years, the world has consumed more silver than it has mined, and that gap has been covered only by drawing down existing stockpiles. Analysts studying the global silver market estimate that this year alone, the shortfall will reach tens of millions of ounces. That is not a small accounting gap. It is a structural shortage that has been quietly building year after year, largely unnoticed by the average investor who only checks the daily price. A cheap valuation compared to gold, combined with persistent multi-year supply shortage, is exactly the kind of setup that tends to attract serious long-term capital rather than short-term speculation. Large financial institutions do not typically chase headlines. They study imbalances like this one and position themselves years before the broader public becomes aware that anything unusual is happening. None of this means the outcome is guaranteed or immediate. Markets do not move in straight lines, and short-term hesitation, like the pause silver experienced this morning, can continue for weeks before anything decisive happens. This is why the coming weeks matter so much. There's a clear sequence of events on the calendar that will shape how this entire story unfolds. In the middle of next month, a fresh inflation report will offer the next real signal on whether price pressures are finally cooling in a meaningful way. Later, in the same month, central bankers from around the world will gather for their most closely watched annual meeting, an event that has historically been used to signal major shifts in policy direction. even through carefully chosen words rather than direct announcements. Then, in the middle of September, the central bank's policy committee will meet to make its next major decision, one that will be shaped directly by everything observed between now and then. Each of these dates carries the potential to shift the picture described throughout this analysis. A weaker inflation reading could ease pressure on the central bank and open a clearer path higher for both metals. A stronger reading could extend the current uncertainty a while longer. Whatever happens, one thing remains consistent across every possible outcome. The conditions created by slowing growth and stubborn inflation do not resolve quickly, and history has shown that this exact combination tends to favor hard assets over paper ones as the situation plays out. This is not a story about excitement or quick profit. It is a story about recognizing a pattern before it becomes obvious to everyone else. Gold has already spoken clearly through its price action. Silver has stayed quiet for now, held back by short-term concerns that do not change its long-term structural position. For those willing to look past a single morning's headlines and study what is actually building underneath the surface, this moment offers a rare window to understand where real value may be forming, long before the rest of the market catches up to what has already begun.